And welcome everybody as the people come in. I always like that view where all of a sudden it slowly starts adding people. It's Ari Rosenbaum here with that 4K virtual conference number 8. We're going to do number 9 on December 18th. And of course, that 4K National Virtual Conference, January 21, 22, 2021. You sign up before Thanksgiving, you can get in the early bird rate of $20.21. Otherwise, you'll probably pay a couple of shekels more, as they say, um, to get this event going, because people have obviously limited time. We're all kind of back to work. I wanted to introduce Roger Jorgensen from Alaris, who always gives us a great presentation on health savings accounts and why every advisor who's not doing it now and not offering it is not doing right by their client, and of course, selfishly leaving money on the table by not pushing it to the clients. So Roger, take it away.
Great, thanks, Ari. Yeah, I tried to think of a provocative title. What could be more offensive to get people's attention than to say the health savings account is better than the 401k? But I hope to prove it as we go forward. I'm going to talk about where HSAs are at today. I'm going to talk about the different types of HSA users. I've been doing this for 17 years. I've got over $100,000 in my HSA. I'm a believer as well as a user, and have been doing education for groups and for brokers and advisors for a number of years, and administration. And so then HSAs into retirement, we're going to talk about that. And then the advisor's opportunity, I want to highlight where I see it's been and where it can go. So in terms of total accounts, in excess of 27 million accounts now are in force in the United States. We've got, as of the last 2019 number, it was $65 billion in assets, of which over 50 billion is sitting in cash, right? Which I've been doing education for a long time, for those since the inception in 2004. And we've talked about the investing vehicle, the power of an HSA. And so I think we have higher, within our organization, higher balances and more people investing. But the word hasn't gotten out, right? Hence the opportunity for advisors. So 15.7 billion HSA investment assets invested, right? And 24% of all HSA investments or of assets are in investments. Average total balance, $16,000. So again, this is the state of where we're at today with HSAs. Now here's an interesting slide that I picked up, which said 56% of accounts have been opened in the last 3 years, 37% of the assets within those accounts in the last 3 years. That's because accounts are moving. As account balances were being built up, investors often have had their HSAs at the local bank. They're looking for investment options. They're looking for better quality funds. They're looking for lower cost. So all of those things have led organizations to move their HSAs to take advantage of that. And some of you may know HSAs really well. I always worry about the folks that don't understand HSAs as well. So I'm just going to go through a few little things for you to understand HSAs better. It has the triple tax advantage. We hear about that. No tax going in, no tax on the accumulation, no tax as it's paid out for those qualified expenses. It is a trust. It's established in the account holder's name. It goes with them at termination, at retirement. I always say it's better than a retirement plan. Unfortunately, you can't put enough money in it to retire. However, it has some great features that really make it great into retirement. My wife's favorite is at death, it transfers to a spouse as an HSA. Anyone else as a taxable asset. This is really a powerful thing. It really caused my wife to want to better understand how the HSA works. And as we've gotten closer to retirement, she doesn't want to spend any money out of the HSA so that we can take it into retirement. And again, she knows it is her money. There's really four kinds of vehicles. I'm going to go through each one of these as I've interacted with the HSA account holders. The first category is the pass-through account. You know, they just essentially are taking advantage of the pre-tax savings. They may view it somewhat like a flexible spending account, the health flexible spending account, where you save on the state, federal, Social Security tax, Medicare tax, and they're using the account to pay for out-of-pocket expenses. It's important for them to have debit cards, right, and be able to access those dollars. A number of these people will spend down their account every year if they have large expense. Again, like the old flexible spending accounts that were use it or lose it, about 90% of account holders today are in this category. They're in this category because typically there is not a lot of education around health savings accounts. Initially there may be, but over time, most organizations don't spend much time to do that. So it's really on each individual person to learn more about their HSA. As I mentioned, contributions, no state, federal, Social Security tax. There's exception on state tax for California and New Jersey. And in 2020, the amount they can contribute, it's really, there's a couple parts to eligibility, but at the contribution level, how much can you put in your account? That is really triggered by your coverage level on the plan. And as you can see, going into 2021, if you have single coverage, it's $3,600. If you have family coverage, $7,200. This amount is indexed for inflation. That's why you see it go up 50 bucks single, $100 family. And if you're 55 or older, you can contribute an additional $1,000. So one of the strategies that we communicate to participants is when their spouse gets to be 55, if they're covered by family coverage or their spouse is eligible for an HSA, to open an HSA for the spouse so that they can take advantage of that additional $1,000. You can change your contribution at any time. That's really important for younger people who are not fully funding their HSA accounts. They incur an expense. They weren't planning on it, but they now have incurred the expense. They can change the contribution, increase it by an amount like $100, and then pay it out over time. They can set up recurring payments within the system and pay that expense off without having to spend out the principal that they've got within their HSA. They can just make those monthly payments, and that's one of the strategies to help preserve their HSA. With an HSA, in terms of taking money out, you can take money out anytime for any reason. It's never taxed if the distribution is for qualified expenses. If it's a non-qualified expense, there's a 20% excise tax if they're under the age of 65. But at 65, it works just like a 401k. If I want to draw the money out, I'll pay income tax on it if I want to use it for other than a qualified expense. But if it's for a non-qualified expense, they are never taxed on it. And you don't have to take the money out in the year that you incur the expense. I've been doing a number of advisor conferences and talking to insurance brokers as well. It always amazes me that people don't realize you don't have to spend the money out in the year you incur the expense. You can wait as long as you want. The key is save the receipt. You can take the money out anytime in the future. And so what are those qualified expenses? Medical, and now because of the CARES Act, including over-the-counter medicines and drugs, so Tylenol and Advil and Prilosec, all of those things are eligible to be reimbursed from an HSA. Dental, including Invisalign and orthodontia and crowns and fillings and teeth cleanings and all of those things that maybe a dental plan doesn't pay for, I can be reimbursed through my HSA. Vision expenses, LASIK, cheater reading glasses, prescription reading glasses, contact lenses, contact lens solution, hearing aids. A lot of people don't realize a health plan doesn't pay for hearing aids, right? But your HSA can pay for hearing aids and the batteries. And then premiums at age 65 for Medicare. I'm going to talk more about that in just a moment, because I think going into retirement, the option to use your HSA into retirement is just a great opportunity, and it's something that employees need to understand better so they can take advantage of it. It can be used to pay for long-term care insurance, COBRA insurance when they terminate employment. Some people retire before 65 and they want to be able to have coverage until Medicare. Well, they can get 18 months of COBRA and they can use their HSA to pay for that premium. And then all of dependents are covered, all tax dependents. So I have an HSA, but if my spouse were covered by a different health plan or my children were on a different health plan, it wouldn't matter. I can use my HSA to reimburse myself for expenses that any tax dependents have on the plan. So what isn't a covered charge? Well, there's really kind of two categories of things. Cosmetic services, something not medically necessary, something just for appearance purposes, and then general health items like health club dues or vitamins or supplements are not medically necessary. They promote general health, but they're not necessary. And so they would not be an eligible expense either. In terms of as a savings vehicle, you know, it's not your father's savings account. I say that simply because there's no interest income tax on the savings within the HSA. So that's one of the strategies. Build your account, have it be a savings vehicle. I had a money market account that we used to pay for emergencies like the hot water heater blowing or some issue or problem within the house. Every year I'd pay interest income tax on that amount. In 1 year, I decided the next time we have a medical expense, I'll spend that money out of our emergency fund. And then the emergency fund sitting in with my HSA, I don't have to pay any more tax on the interest. I can invest it. If I ever need the money, I can have it within 2 days by making a request, and it'll be direct deposited into my checking or savings account. It's no taxes. I pay it out for qualified expenses, as I mentioned before, and I don't have to spend the money on the expense until I want to. So an HSA is really unique in that it's the one product that people control. They determine when and how they want to put money into their HSA and when and how they want to spend it out. Now, as an investment vehicle, it gets more interesting, doesn't it? The HSA, there's no capital gains, right? So I'm always telling employees that if you are doing investments outside of your retirement plan, you're going to pay capital gains, but that does not happen within the HSA. And we can duplicate the funds on the 401k that you have in place, and we can duplicate those funds and put them within the HSA, which really helps streamline some of the education. And then we can do models as well, and then also target date funds and whatever the advisor wants to set up within this HSA to duplicate the 401k. And there's no required minimum distribution on an HSA, so they don't have to begin drawing it out if they're healthy and they want to leave the money ride. They can certainly do that. Additionally, you know, one of the things that people often point to, Fidelity has a study, 295,000 needed for a couple age 65 if they were retiring today. Those are after-tax dollars, right? The Kaiser Family Foundation says retirees will spend 3 times the amount on healthcare than the average working household. And this is produced also by Fidelity, I believe. And it just shows what the spend is in retirement on Medicare and on other medical expenses and prescription drugs and those kinds of expenses. So we know retirees have that spending. So as people basically from 50 on, maybe even 40 for some groups, professional groups, but from 50 on, people are talking about retirement, they're thinking about retirement, and the HSA provides a great vehicle for them to go into retirement to pay for those out-of-pocket expenses. In terms, I mentioned COBRA, they may retire before 65, but Medicare kicks in at age 65. And so then they may want to take COBRA early. And again, they can use their HSA to pay for that. Now, Medicare Part A is hospital coverage, right? There's no premium if you've worked 40 quarters or more. However, a lot of people think, well, when I'm on Medicare, you know, I won't have to pay anything. But there's a $1,408 deductible. There's daily copays after 60 days in hospital of $352 a day. $176 daily copay for skilled nursing after the 21st day. People are unaware of this. I'm always telling people, you know, build your HSA because it'll serve you well into retirement to pay for these expenses that you're going to be incurred in a situation where you're on Medicare. And if you're in hospital, these are the kinds of expenses that you're going to have. For Part B, that's the doctor coverage, right? The premium's deducted from a Social Security check. Most people don't realize that either. So when you elect the Medicare B and Medicare D, those come right out of your Social Security check. If you've accumulated money in your HSA, you can simply do a transfer back into your checking account for those premium amounts because those are eligible expenses. In 2020, the standard premium's $146.60, but it's dependent on your income when you go into retirement in terms of what the actual premium's going to be. And you can see that for higher incomes, the premium's higher in terms of the Medicare premium. Now, maybe it won't matter to you if you're making over $750,000 what you're paying for that premium, but I can tell you it does matter for folks who are earning significantly less than that. And so they're trying to figure out how are they going to pay for those expenses in their retirement? Will they have to draw down from their retirement plans, or in this case, are they going to use their HSA? And then Part D is prescription drug coverage. Now the premium doesn't seem that much, $32.74, but it's increased by these amounts depending on income, right? So that's just another expense that they have in their retirement. And again, Premium D is an eligible expense paid from the HSA. And then Medicare Advantage, in a lot of areas, they're outselling supplements. The two areas I kind of track are in Minnesota and North and South Dakota, Wisconsin, and then down in Arizona. And I know Medicare Advantage plans, those are, we call those, you know, Part C of Medicare. Those are eligible expenses. Supplements are not, but they're outselling supplements in a lot of areas. And that premium can range from 0 to 160, including prescriptions, maybe including dental and vision. It just depends on the Advantage plan. The Advantage plans are county-based, so they're going to be with providers in the county, whereas the supplements insurance, and then it basically doesn't matter where you're living in terms of your coverage with the supplement. Again, these premiums can vary year by year. People look at them every year. So supplements are about $230 per person, pretty stable, but renew annually, and those are not covered by the HSA. So here's some strategies that we use in terms of education, and these are things we impart also to our advisors to help them if they're doing any mentioning of the HSA within the retirement plan education. You know, building your balance, so bank your expenses, hold on to the receipts, right? Because if you're ever audited by the IRS, you'd have to produce the receipts, but you can accumulate money within the HSA. In retirement, use your HSA to pay for those supplements by taking out money for the eligible receipts you bank. So I've got thousands of dollars I have paid for out of pocket. I've kept the receipts. And when I am on Medicare and I am paying for it, I may then transfer the money, you know, from my HSA back into my checking account to cover those expenses that I've had with Medicare. So your meetings are focused on saving for retirement and investment education. Building the HSA into that education just fits nicely. Unfortunately, the typical open enrollment meeting, when we're talking about benefits and we're talking about the health plan, we spend a lot of time talking about the deductible changes, the contribution changes, changes on the dental plan, changes on the vision plan, you know, PTO, all of those things are covered in the annual open enrollment meeting. So the amount of time that's spent on HSA education really is negligible. I just believe, and I've seen this living out, we have 401k plans with many of you, with advisors, and we're incorporating the HSA education. People are more in tune to saving for retirement, and the HSA education works out well in there. And when we duplicate the 401k funds, we don't have to deal with separate type of fund questions in those meetings. The funds are pretty well known over time. And we can pay the advisor for those fund lineups within those accounts. Of course, all that depends on broker dealers and all the concerns there, but we have a number of advisors that we have duplicated the funds and that we are in fact paying them. And the primary concern for employers, what do you think that might be for HSAs? Well, I can tell you 61%, this is from Plan Council of America, they did a survey, and employee education was the #1 question. Do my employees really understand how the HSA works? Do they really understand the value of it? And the answer is probably not. Matter of fact, most employers themselves, the HR department, can't answer, 5 of the 10 features of an HSA in terms of how it works. So education is a huge issue. That's why I believe employers are willing to pay advisors on those HSAs, because the employees will better understand. And by the way, you realize that the employer saves on FICA and Medicare tax, right? For every dollar the employee contributes into the HSA, 7.65%. So the HSA really saves the employer money. In my case with Alaris saves over $600 a year on my HSA contribution and my flexible spending, limited use flexible spending account contribution. That's significant. When you take it times 800 employees, that's a significant amount of money. So education is important to get employees to better understand their HSA, so they will fund it. HSA participants are largely missing out on the value of investing their HSA dollars. If you look at this, 13% have invested their HSA assets. Now that number fluctuates year to year from somewhere between 10% and when you're looking at assets, or if you're looking at participants, it's significantly less than that. But 54% didn't know that they could invest their HSA funds for growth. 20% claimed to have little confidence in the topic of investments in general. And why are 87% not invested? That's because they don't get any financial guidance at a typical benefits meeting. People aren't thinking about retirement when they're talking about benefits. They're talking about, what if I incur my deductible this year? And not what is the landscape going to look like when I turn 65 and I have to pay for Medicare? What's that going to look like? So I just want to really, this is almost the end. At age 65, if I use the 401k to pay for my medical expenses, I'll have to be taxed on it, right? As I'm drawing the money out, I'll be taxed. But from an HSA, there is no tax on those qualified expenses. So with the HSA, $100,000, you take out $100,000, but if you take that out of a 401k, depending on your tax bracket, what's it going to cost you? 15 grand, 20 grand, 25 grand, depends on your tax bracket. But again, it's going to cost you something in tax. And so building up your HSA in the retirement really can be a benefit to everyone. So again, as we align HSA investments with 401k investments, advisors will influence employees toward greater savings and investing. If you have any questions or information, you want to talk to me, or if you would like me to send you any information, just feel free to reach out and talk to me. So I'm going to just see if there's any questions.
There are a couple.
Yeah, the first one, I love this question. So there's a guy, and I forget his last name, but Dan, who was a lobbyist when we were first doing HSAs. And he told me the magic number with Congress is if we get 5 million accounts, it's really hard to take them away. And matter of fact, I can tell you, having talked to a number of organizations, there's a few organizations that will notify their Congress member in a district how many HSA accounts exist in their area, because they want them to know how significant a population that they're serving that have HSAs. So from a standpoint, having talked to a number of different people about the legislative climate, there really is no downturn for HSAs unless we went to Medicare for all. And I hope you all are aware what the challenges are to do something like that would be. So people love their HSAs, and I really think they're looked on favorably. Now, initially, it was more of a Republican strategy, and Democrats didn't embrace it. But now we have unions, and we have school districts, and we have a lot of typically Democratic groups that have HSAs, and so I feel the future is looking pretty good. Can you have automatic enrollment in HSAs? No, that's a great question. You cannot, because HSAs are they have to be voluntary. People can have numerous HSAs if they like to. Wouldn't necessarily make sense with fees and everything, but they could. And so again, it's automatic. It's absolutely voluntary on their part. That's one of the reasons why we suggest employers make a contribution. And I've learned it doesn't have to be much of a contribution. It could be $50 for the year, and that'll be enough for getting most employees to fill out the paperwork to enroll in an HSA. Any other questions? All right. Ari.
Yes.
Am I done?
I think you're done.
Okay, I will stop sharing. Thank you.
Not a problem. I always appreciate the presentation because, way back when, in Disney World, feels like 20 years ago.
Yeah.
But time tells me it was only about 8 months ago when all this started. I thought it was a great presentation then, and I still think it's, again, I think that people with HSAs, by not pushing it, it's just an opportunity lost, not only for themselves as an advisor, but also for their clients. So I appreciate it.
Well, Ari, thanks to you, I have a picture of myself and Goose Gossage on my wall. So,
eventually we're going to get back to live events. We got that national virtual event with Walt Frazier and Doc Gooden. We can't do pictures and all that. And hopefully, we'll get back to live events. And, that one of the events that we postponed was Minneapolis. So they still have my money for a deposit. So hopefully in June, we'll come back and we'll be Minneapolis, because I've been promising my daughter a trip to the Mall of America for about 6-7 years now. So
awesome.
So I appreciate it.
Thank
So
you.
great. Thank you so much. Next presentation, EvoShare. Chris Miller is going to be here. I see Chris. EvoShare, again, is one of these great benefits that nobody talks about, and they really should, because again, it combines two of my favorite things, 401k plans and shopping. But I believe that EvoShare has something more to add to the discussion of shopping and 401k plans. So Chris, take it away.
Yeah, appreciate it, Ari and Roger. Great presentation. HSA is seriously one of the best retirement accounts out there. I'm Chris Miller, Chief Revenue Officer of EvoShare. Brief background about myself. I've been in the retirement 401k industry for 18 years, Merrill Lynch, Hartford, Transamerica's a 401k wholesaler. And then I went over to Benchmark BD RIA, where I managed their 338 and managed account products for our 250 advisors. And as I was looking at products in fintech, I fell in love with EvoShare. I was a big proponent of Rakuten. My wife and I got $900 about a year ago from Rakuten, and I wish I could put it into like an HSA, as Roger was speaking about, or a 529 or a 401k brokerage account, et cetera, but I couldn't. It went right back into my bank account. So that's why I joined EvoShare. So I'm going to share my screen to walk through the presentation. And I think everyone can see my screen, right? Ari, you can see my screen? All right. I'll just assume that you guys can all see my screen.
Yeah, I can see it.
Thanks, Ari.
No
So, EvoShare, cashback isn't anything new. It's been around for years. Like I said, Rakuten and Honey are the two largest in the world that give cash back, but we differ. Rakuten and Honey, they give you cash back, for shopping, your everyday spending, but they send it right to your bank account. EvoShare took that concept and we said, why don't we create a third bucket? You've got employer money, you got employee money. Why not create a merchant bucket where we could take everyone's everyday spending, turn those dollars to fuel their future growth in some sort of retirement aspect, whether it's 401k, IRA, et cetera. So that's what that's how EvoShare was born. We started in the 401k and we've greatly expanded. And as I'm walking through the presentation, I want everyone to not only look at it from a financial advisor perspective, look at it from an employer perspective, look at it as possibly a user perspective, but also too, look at it from a marketing perspective. We are changing the way advisors market, and I'll go through that. So EvoShare, let 10,000 merchants and 700,000 hotels worldwide fuel your business growth. We've been in Forbes, 401k, Plan Sponsor, a bunch of magazines, and Investment News said it best. Spending and saving are kind of like oil water, but there is one company that has figured to mix the two, and that is EvoShare. This is just a slide that kind of shows all of our partnerships, kind of the who's who in retirement from a national stage, SageView, GRP, Resources, the Katie companies, et cetera. We are aligned with ADP Marketplace and Paylocity. I'll go into a little bit why that's important from a 401k perspective. We are complete PCI compliant. We've gone through an exhausting due diligence with all the major credit cards, Visa, MasterCard, American Express. But here's really where the rubber meets the road for everyone. You know, United States this year passed 11.8 trillion in consumer spending in Q2 of 2020. Americans spend about 18,000 a year on non-essential items, top three categories being meals, drinks, and takeout delivery. So how do we get cash back? Real simple. There's two ways. Online stores is one. We've partnered with over 1,300 online merchants that give 20% cash back. Home Depot, Walmart, Macy's, Udemy, Nordstrom's, Expedia, Travelocity, DoorDash, just to name a few. And essentially how it works is it's basically a commission behind the scenes. So all these retailers, they want to grab the user's attention. So if Ari's looking to buy a lawnmower, he could go to Amazon that gives 0% cash back, or he could go to Home Depot that gives about 4% cash back on that same lawnmower. So we're hoping, or the retailers and the restaurants and the hotels are hoping that Ari, or you, or your users will go where cash back is offered. And then what EvoShare turns around and does is we put that towards their future. We also do local shops as well. This is mainly when you think local, think about restaurants. We have 8,700 stores nationwide that give up to 15% cash back. We have a lot of local chains. If you type in your zip code, go to evoshare.com, type in your zip code, you'll see all the restaurants that participate in cash back offerings. But these are some national chains, Denny's, Jersey Mike's, Burger King, Jack in the Box, nationally that give up to 15% cash back. And this we just launched. We're super excited about this. The average user gets about $140 cash back. We just added Evo Travel, and this is really great. So once travel gets back into mainstream again after COVID-19, travel is really going to pick up, and we offer our users hotels at not only a discount, we also offer them up, even though the slide's incorrect, we actually offer them up to 50% cash back in some cases. Here's a prime example, Miami Beach, the week of Thanksgiving, next week. If you were to book the Palms Hotel and Spa, not only are we giving you a discount of roughly almost $300 to Priceline Hotels and Orbitz, but we're also, look at this, we're giving you $600 cash back on one trip. So $600, one trip cash back, put towards an HSA of $529, an ESA of 401k. This is powerful stuff, you know, for the average user. And remember, this is just in one 12-month period. Obviously, we all understand compounding. What this could mean in 20 years, 30 years, could be ginormous to the user. So where do we all deposit cash back? Because the IRS deems cash back as non-taxable event, so it's rewards. So this money is never taxed. So it can go into, EvoShare started out in the 401k. We figured it out, and it's very difficult, very complicated, but we figured it out because ERISA doesn't allow for third-party contributions to go into the 401k. But because we've integrated with Paylocity and ADP from a 401k perspective, it's essentially how the 401k works is, let's say Ari at the end of the quarter earns $50 cash back. We send $50 to Ari's bank account, and then we notify Paylocity or ADP and would say, hey, deduct $50 Ari's next paycheck whether he's going into a pre-tax or to a Roth. So it's really a wash. I get 50 on one hand, I lose 50 on the other hand, but it's a net positive, especially if I'm going into the pre-tax. But it really only works if we're integrated with payroll. It could work without payroll integration, but we've all had those talks with HR. Anytime you put a manual process on HR, no one wants a payroll problem. So we only really pitch the 401k if you have Paylocity or ADP payroll. But what a lot of our retirement advisors are thinking about is rather than going through the 401k, they're like, listen, why not the HSA? We just signed the largest deal with Wex Health. Wex Health, I believe, actually does the back office for Alaris and a few others. So they could do the HSA account. We could do 529 accounts, and it's real simple. All they do is they put in their account number and routing number, and every quarter EvoShare sends that cash directly, to the account that the participant specifies. We also do IRAs and Roth IRAs. In fact, BPAS, which is a large record keeper, just launched My IRA Rewards. So they're, instead of the 401k route, they're going the IRA route and saying, hey, it's easier. People are eligible for the IRA. Let's jump it, start with it with a cash back, through EvoShare. We also can pay down student debt loans as well. But the most requested one that we just launched 2 weeks ago is emergency savings accounts. Everyone's eligible for emergency savings account. From an advisor perspective, it makes you look good, especially during COVID-19. This is free money. And all this money, by the way, is on top of whatever you earn with your credit card. The two don't negate each other. So this is really almost kind of like double dipping. So the emergency savings account is kind of the easiest. You could go to your employer and say, hey, listen, this is free money. This will help your participants out. We don't have to go the 401k route. We can literally open up any one of these avenues. So how does a person actually get cash back? Well, there's two ways. I mentioned online and local. Online is the browser extension. So what they do is they download the browser extension, and the browser extension will notify the user that, hey, this is a retailer or a hotel or travel site that actually gives cash back. So it kind of takes the guessing from the user's name. And then when the user goes to Groupon or Macy's or et cetera, they're going to see a pop-up window here where all they do is click activate cash back. But what's really important that EvoShare does is that we're always constantly reinforcing retirement. So for example, we have messaging down here to the user that says, if 100 spent, based on your age in the year 2051 of retirement, this little transaction could be worth $50 by the time you retire. That is absolutely enormous. And I'll take you through a live example if we have time. We also have the ability, and this is where the advertising is huge for an advisor, especially if you're an advisor that wants to mix transverse from retirement to wealth or health, right? Maybe you just have one product. You have the 401k with 10,000 users and you would like to do more. You would like to do IRAs. You'd like to do rollovers, insurance, et cetera. We can actually take the EvoShare brand out and put your brand. I mean, think how powerful that is to be on the front page of Google at 1 million plus search items on the hide of these advertising dollars of these big conglomerates. I mean, you couldn't pay for that kind of marketing. Big companies couldn't pay for that kind of marketing. I could put your logo and your brand at 1 million plus search items. And not only that, down here where it says ad goes here, I can have a clickable action. So for example, let's say you wanted your users and their friends and family to go to your mobile app or go to your products page. I could instill that in there. And yes, friends and family, this is the gift that keeps on giving. So you have the ability, not only if you have 10,000 users, you actually have 50,000 users with friends and family. So let's say I'm in your 401k plan and I'm currently using EvoShare for the ESA or HSA or 401k, right? I just saved $500 cash back on a hotel or $100 cash back on a hotel. I tell 5 of my friends and my family, well, guess what? Every time they go to Google, they're going to see your brand constantly. So literally I could put your brand on every major on the front page in the first 5 lines, 10 lines of Google every time someone browses the web. And how often does someone browse the web? Pretty much every day. So think about the campaigns you're currently running where, maybe I'm going to do a 529 pitch. Maybe I'm going to do an annuity pitch. So you send out a mass email out to all your users, hoping that that person at that time, particular time, is thinking, hey, I need a 529 for my kids, or I need to review and re-up my insurance policy. Here, they're constantly going to see your brand every day. And if it's true, and I truly believe this, a participant has a financial need every 10 years of their life. You know, you have kids, you upgrade houses, you need mortgage, you know, you have a death in the family, whatever it is, you constantly need financial products and you need financial advice as we navigate through our lives. So why not have your brand constantly in front of them? And next, we also have the mobile app experience as well. And with the mobile app experience, you can also brand the mobile app experience. And here's what's so great about that is that EvoShare has push notifications and text messages. So for example, and I'll walk you through the local in a minute, you know, you're driving down the road and one of the participating restaurants that gives cash back, you'll get pinged and it will say, Ari, 8% cash back Burger King, brought to you by Cap Trust, Pension Mark, GRP, whoever, right? So it's that constant reinforcement of branding that is going to hit the user. And even if you forget to activate the offer, let's say you're in the restaurant, you're going to get pinged to say, hey, activate the 15% cash back now, brought to you by, you know, you plug in the name. So this kind of ecosystem branding, not only is it a great idea to get free money, right, and help support your retirement goals, but it's also a way to get multi-generational wealth from you as an advisor. So you've got one client, you can take this to their grandkids, to their kids, to their spouse, friends, and family. It's uber important. And like the friends and family feature, someone can all join in to help with the kids' 529 if they wanted to. So it's very, very good, not to mention the branding for you, but let's say you've got a big client that loves their brand and they have 50,000 employees. They can brand it as well. And when they send out the link, anyone who goes on that link will see that branding. And here I'm going to show you the experience. So for example, here's the local shopping. I'm going to just put in my zip code. I'm based in Florida. And depending on where you're located, obviously you're going to have more venues than not. Manhattan in New York has about 2,000, you know, participating places. So for example, this is Florida. I live in Sarasota. You know, I get cash back at Rico's Pizza, Wings and Things. And all I do, whether I'm online or in the app, I just activate the offer. It's ready. And as soon as I swipe my credit card, I get cash back, you know, in my system. So this would be the local experience. I also have Evo Travel, where what's so great about this is, you know, for example, I can do, let's do New York. Actually, let's do Manhattan. All right. Manhattan. Well, let's do that's my old stomping ground, Manhattan Beach, California. And I'm going to pick, let's say, Monday through the 11th, and I search. So the user experience on the mobile app and here, through their travel, they all stay within our ecosystem. So they're not going to leave the ecosystem. They're going to be able to book their hotel, get the transaction done, and they'll see everything online right then and there. And you can see right here. So this is West Hollywood. You know, that would cost me $16.48. It's, you know, a little bit cheaper, about $50 cheap, $52 cheaper than Priceline. But look, I'm getting $222 cash back. Down here, Brandwood, $841. I'm getting $193 cash back. So these are significant amounts that can go into where you want to take it as an advisor, right? Whether it's, like I said, emergency savings account is the most popular one right now. And if you think about financial wellness overall, we always hear about financial wellness. Some people use eMoney, some people use Enrich. There's a lot of services out there. The problem with financial wellness is it's a really good offering, but it stops short of call to action, right? It gives you budgeting calculators. It talks about an emergency savings account, talks about HSA or IRA, but there's no call to action. EvoShare is that call to action, right? Because we are taking everyday spending from users and putting it towards some sort of retirement goal, some sort of retirement account. And we also have the ability at EvoShare to do a revenue share. Typically, our pricing model works like this. We have gone to a user pricing model. We typically charge $1 per user per month. So it's $12 for the user to have EvoShare. And out of that, that's our street price. And depending on how many users you bring to us, we can always scale that price down, right? But that ROI is crazy. Think about it. If you get $104 or you get $300 or $900 cash back, and it costs you $12 to have the program, that ROI is ridiculous. And we typically give a 90-day refund money back if they don't like the program or don't want the program. But we do have the ability out of that user fee to revenue share with the advisor if that's something that they want or that's something they do. Now, obviously, if it's 401k, ERISA has rules, fiduciary rules, you can't really revenue share. But if you do one of these non-employer type accounts like an ESA or something of that nature, you can certainly look into that. So it's quite amazing from that standpoint. But really, that is pretty much it when it comes to the presentation. But I do want to show you the personalized branding just so you don't think I'm making this stuff up. So here we go. I got personalized branding, and here we go. Voila. We all know, I hope we all know who Transamerica is. That was my old stomping ground. So anyway, in here, I search, and let's say I type order food. All right, I'm a participant. I go to Google every day. I type order food. And then boom, past the ads, I'll see DoorDash and I see the Transamerica logo, $15 cash back. I go down, I see Grubhub, 3.75% cash back. And think about if this was your brand up here. Not only is your brand out there to your users and their friends and family, but also the brand is associated with what? Think about the positive feeling. Every time I see your brand, I'm correlating it with what? You're putting money into my pocket, right? That's a powerful messaging. That's a powerful, type of brand. And then if I type in Macy's itself, boom, you're going to see Transamerica pop up. The user will see this, or they'll see your brand. And here's the clickable action down here. I just click on this and Transamerica will take me to voila. It will actually take me to their product page, right? And then all I do as the user, I simply activate the 3% cash back. It says, boom, it's been activated. You close it and then you shop as usual. And what's going on behind the scenes is because of that browser extension, we are now recording your shopping trip, the user's shopping trip. So what happens is behind the scenes is what you go through your trip, you buy what you're going to buy, and then EvoShare and Macy's talk with one another and say, hey, Ari just spent $200 at Macy's, is getting 3% cash back. Pay us the commission, Macy's. Macy pays EvoShare the commission. And then at the end of the quarter, EvoShare puts your 3% into your account where you designate you want the money to go. Now, online works different than local. Like local restaurants, you get the cash back instantaneous, right? With online, the difference is it's not instantaneous because most online shopping has a policy of 30-day refund. So we typically will not see the commission till after 30 days. And then on travel, we will not see the commission till you actually stayed on the trip. So if you book the hotel 3 months in advance, you are not going to get the cash refund until you actually have that trip. But this is wild stuff. This is new. And as I was at PensionMark looking for something new for my advisors, I love this concept because it's free money. Everyone loves free money. Everyone should be doing something like this because you're spending. We can't stop them from spending. But now what we could do is we could take that third bucket of money and put it towards some retirement account. Obviously, I'm here to help everyone out. If you're interested, I would definitely say take a look at the 401k. But what we're finding is it's much easier doing the HSA, much easier doing the ESA, or whatever. Student debt is a popular one too. So it's something that can not only make you look good from the employer, but you're adding something new to the employer, right? Versus talking about the 3 F's: funds, fees, and fiduciary. Right? So this is something new. We've been around for 4 years. We're growing very rapidly, very quickly. So we love to partner with you, hear your ideas. So right now, I'm going to stop the presentation and answer any questions that you guys might have.
Yeah, and you have a whole bunch.
All right. All right. Do I just click on the Q&A?
Yeah,
is that what I bring up?
Click on Q&A, or do you want me to read the questions for you?
I think I got is the first one is EvoShare integrate with payroll systems other than ADP and Paylocity. We are working on it. Currently, no, the answer is no. Right now, it's just Paylocity and just ADP. Next question. So the participant can manage their contributions via an app or interface, and then the payroll, flows from there. Yeah. So, the participant, one thing I didn't mention is we do have the ability we have what's called impulse savings. So it's kind of cool. We don't do what Acorns does where we round up. We actually, and it's one of our most popular features on EvoShare. When you sign up for EvoShare, we actually, in addition to cash back, we say, would you like to, impulse save 25 cents a day or $1 a week or a one-time contribution of $20 or $30. So we hook up with their bank account, right? We do ask them for their bank account information. So if they want to do this, we could certainly do that. But basically, the way payroll works with the 401k is, like I said, Paylocity and ADP, they have the deduction codes. It has to be a flat dollar amount. The record keeper has to allow for flat dollar contributions if it's going into the 401k. So Chris, do I need an employer for EvoShare, or can it be like Honey and Rakuten? Okay, so here's how it works. EvoShare is B2B, we're not B2C. So we need a sponsoring entity. So that can be an employer, that can be a broker dealer, that can be an RIA, that can be a fintech, type community. It could be an HSA, a TPA, or a back office system. We just need someone to be the sponsoring entity in order to give EvoShare. For example, like we have we're about ready to sign with a online brokerage firm. So this money is going to go into their brokerage accounts, but that brokerage firm is the entity. That online discount brokerage firm is the entity. So when they go after new clients or existing clients or friends and family, they will all have to open that brokerage account in order to get EvoShare. Does EvoShare have any competitors, or are you the only ones doing this? Great question. In our field right now, we have zero competition. We're going to get competition. I mean, Rakuten and Honey, like I said, they're NFL, we're Pee Wee League currently right now. But we are the only ones that have figured out how to do it to 401k. We actually are the ones that are the only ones figured out ESA currently today. ESA, you don't even need to open up a bank account. We store it as points, and then we send the money when someone has an emergency and notify us emergency. So as of today, we really don't have any competition because Rakuten, Honey, and Dash, they're B2C and we're B2B. How much does this cost a small business enterprise typically? Well, if the employer's paying for it and they don't want the employees to pay for it, we're typically $100 a month to the employer. With 401k, we do have a one-time fee of $2,000 because it's a lot to set up, for the 401k. It takes us about 25 man hours to set up one employer for the 401k. So we do charge for it. But a lot of advisors are going to the user model. And like I said, they're going to the ESA or to the IRA or to the, HSA. All right. Did you guys work with Vestwell? I thought I saw their logo earlier. Yeah, Vestwell is actually a client of ours. They currently are using EvoShare for their 401k for their own employees. They haven't rolled it out to outside of their employees to users, but definitely if you're interested, they're a big proponent of EvoShare. And is that it? Are we good?
That is it.
All right, Ari. Well, I appreciate it. Ari's got my contact information if anyone wants to reach out to me or, do a more deep dive for sure. But I appreciate the time, Ari.
No, I appreciate it too. When I first heard of EvoShare, I was reading an article and I reached out to Jose and they sponsored the event we had at Dodger Stadium. And that's how they met JD Carlson. And, it's been it hasn't been 2 years now. And it's nice to see that EvoShare is continuing to, great success, as I say.
Thanks, Ari. I appreciate it.
Okay. Thank you so much.
Thanks.
Our next before we're a couple minutes early, I just want to make mention of the events before I introduce Tom. We are going to have on December the 3rd, that is a Thursday, my buddy Larry Davis, who, for those people who attend that 401k conference events, they know that Larry Davis is the kind of the celebrity booker for our events. He brings the athletes over. He's also a good friend, and he's also an advisor and a whole host of other things. So he will be the guest of that 401k virtual bunch. We'll talk to Larry about the memorabilia business and how he got involved. He was a vice president of Steiner Sports. They had a TV show at one time, and his experiences, and even some of the advisory work, because he does work with an advisor on the island. After that, we got on December the 18th at 401k virtual conference number 9. That's going to start at 12 noon. And of course, my presentation at 2 o'clock will talk more about that 401k National Virtual Conference, January 21, January 22, 2021. That early bird special is going to go by after Thanksgiving. So that's that. And our next presenter is Tom Lonkar from, I pronounced it right?
Hey, you pronounce it right. Tom Lonkar.
Listen,
You got
I've spent 48 years, well, not anymore, but ever since Ari Gold on Entourage, it's made my life a little bit easier in mispronouncing my my name. But I'm always cognizant of the importance of pronouncing people's names right. Tom, I met you that time in Philadelphia, wasn't it, at the conference at Citizens Bank?
It was at the Philly Ballpark Citizens Bank, and it was a great time because of the folks that were there. We actually got the Fanatic, or you got the Fanatic to come out, and the Fanatic was hysterical. The mascot for the Phillies.
Fanatic was great. He found out I was a Mets fan and pulled my tie and almost choked me to death. And before you start, I just want to say that I don't know how many, we had like 15, 16 events before COVID shut us down, and we'll be back again. That is the only event that I did not wear the jersey from the home team. As I jokingly say, I would rather wear an Al Qaeda jersey than I would a Philadelphia team jersey. So that's then and there. Sorry to Philadelphia, great city. Not a big fan of their sports teams, but it's a fantastic city. Tom, take it away from Invesco.
All right. Hey, good morning. Good afternoon, folks. Thanks for joining us. And I wish everybody is, I hope everybody is all healthy and safe and happy. And excited that Thanksgiving is next week. So hopefully everybody gets to enjoy with their families and friends. So I am the retirement consultant, the senior retirement consultant here with Invesco. I cover the entire New York City region. So that's New York City, Long Island, New Jersey, Westchester, New York, Rockland County, New York, and also half of Connecticut, Stamford and Greenwich and Fairfield County and New Haven County, Connecticut. So if I haven't got a chance to meet you yet, I definitely will reach out and introduce myself over the time. What I want to share with you today, this is part of our Invesco consulting group. This is a number of practice management presentations that are really engaging and help us as advisors as we communicate to our clients. How do we communicate effectively? And how do we communicate effectively so that the message we're sending out to our clients, whether it be plan sponsor, participant, retail, et cetera, is engaging to that audience. So this topic today is called Redefined Contribution Plans, Engaging Participants with Clarity. I apologize, Ari, I need to share the screen. Okay, I got control. Here we go. My apologies, folks. I was about to talk without sharing my screen. Okay, Ari, everybody can see my screen now? Thumbs up, thumbs down. Okay.
Yes, we can see it.
Perfect. All right. So our presentation is all about words matter. It's not what you say, it's what people hear. And that's a big trend that's out there. Because a lot of us, as we're communicating to our clients or participants, whatever meeting you're doing, I know I even get caught up sometimes. We talk in our jargon. We like to use our jargon, and our jargon may, in essence, may not resonate with plan sponsors. Plan sponsors are really with participants. So here's some of the jargon that's out there. Target date funds. Everybody knows what a target date funds. But believe it or not, some folks, when we actually, and I'll talk about the study we did, target date funds, that term doesn't always resonate properly with plan participants. We talk about glide path. What is a glide path? I'm going to share with you how that's actually maybe not actually the best connotation talking to what a target date fund is. Financial wellness, best in class, low cost, manage my risk, financial freedom. Some basic terms that we use on a daily basis. But we want to kind of take a look at this and see if this is really the right outfit overall. So what we did here at Invesco Consulting, we actually partnered with Milensky Partners. They are a leader in looking at emotional responses to language. And we actually conducted the largest financial survey language study in the country. We actually went out with Milensky and Partners, and we solicited 1,000 audience members from plan sponsors directly, the actual folks that we speak to when we're trying to sell a plan or a relationship with the plan. We solicited plan participants, and we solicited, clients that are, working in the financial field and looking at financial wellness programs. And the audience members were right across the board of different demographics. We had union participants, we had non-union. The male to female gender ratio was about 50-50. And these were clients from small-end clients to the larger clients, where in essence they had anywhere from 5 to 10,000 employee groups out there. So we solicited 1,000 folks. And what we did was we went out and we positioned common talking points, how we as the advisors, how you folks communicate to those participants and those plan sponsors. And then we took those same questions and we asked, how does these questions or how do these statements make you feel? How do you resonate to these certain words? And it's going to be surprising. I'm going to take you through a number of different ways of, our common language, and what we say may not resonate with plan sponsors overall, because we always say that when we say words matter, that when words hit us, it hits us in our gut first, and then it hits it into our brain and understanding what it is overall. As I mentioned, it was the largest study ever done on language on financial services. And when we look at plans, we look at, the success of plans. When we're communicating this to our clients or our plan participants or plan sponsors, it's all about plan design. It's about plan governance. It's about investment strategy, and it's about participant engagement overall. And that's really the language, how we communicate to our clients. So here's what we did. We actually did a testing of conventional language, and we did a study. We did a study on language, and this is actually, I'm going to read you a common educational meeting opening. And what we did is, this little chart you see up here is how the audience, out of the 1,000 group audience, how they were engaged with what I'm about to read you. This was from a live example from an educational meeting that was either done by an advisor or it was done by actually one of your record keepers you may have worked with, just to be cognizant. And if we see if the line falls about on 50, if in the middle, it means we flatlined the audience. If the line went down below 50, we lost the audience or we killed the audience. If line went up above 50, it was favorable. They like what they were hearing. So here's the message from one real live example. Here it goes. As an employee of your company, one important benefit that is available to you is something called a defined contribution plan. The defined contribution fund investment options are intended to be primary retirement savings vehicles for members, another name for the employees who enroll in the plan. Members have investment discretion over their accounts by selecting among an array of investment options designed for retirement savings. Members choose from 3 kinds of funds: stock index funds, target date funds, or self-managed funds. The plan seeks to achieve a range of long-term objectives. At its most basic level, it aims to offer a diversified mix of investment options that span the risk-return spectrum and give members the opportunity to diversify their accounts. So how do you think we did? How do you think that message resonated with plan participants at, say, an educational meeting? Well, right across the board, we flatlined it. Right across the board. Did it resonated? Not much at all. We basically killed the audience. And if you've seen this in your audience members when you're out there doing educational meetings, or if you're bringing out a specialist from a record keeper provider to present for you, Be cognizant of the message that you're delivering. So here's another way on really, in essence, positioning that same statement, but in a different favorable way, something that I'm sure all of you on this phone are delivering, but just to be cognizant. Here's how it goes. Same message, different way of presenting it. Welcome to our company. One of the benefits we offer is a voluntary savings plan that can help you save for your future. We've continuously improved our plan to take advantage of strategies that have been shown to be the most successful at helping people grow their assets over time. Our plan offers a tax-smart and cost-efficient approach to long-term investing. It lets you invest pre-tax compensation so you keep more of your money. Because of our size, we've negotiated lower fees so you can put more of that money to work, and with our company match, we can significantly increase the amount you can put away. Same message, a little bit different. How did it respond to the testing polls? Right off the charts, it went up to 70 to almost 90%. It was very favorable. And why was it favorable in this message? This message was all about you. Participants like to hear their name, at least, use their name personally, but they want to know it's about them. We talked about, keeping it simple, basic language, a voluntary savings plan. Because believe it or not, people do not know what a defined contribution plan is out there. The regular public, no clue. And then lastly, we're helping people grow their assets over time. So again, it's all about helping them and being in front of them and keeping it simple overall. Here's one more approach I want to also show you. This is around financial wellness. Another live example around financial wellness that was delivered from a live audience. So here's how it goes. Let me know how this makes you feel, or if you think this is a good way to message out to the employees. Financial wellness is all about feeling empowered with tools and information you need to confidently navigate your finances. As part of that effort, we're reaching out with an update on your progress for reaching your retirement goals. We have found that 2,743 peers at our company who have a similar age and income as you. How do your key retirement plan measures compare to theirs? Based on 16 metrics, such as your date of birth, annual salary, current savings rates, and others, we have determined the following. First, your progress toward income replacement in retirement is in the 29th percentile compared to your peers. Second, the balance in your retirement account is in the 32nd percentile compared to your peers. How's that sound? Make you feel good? Think the audience liked it? Absolutely not. We destroyed the audience. That response went down to almost zero. Very unfavorable. Why was it very unfavorable? People don't want to hear statistics. They don't want to hear that they're in the 2,743 peers. It's not really self-rewarding. It's not about them. It's about a whole big group. They don't want to hear they're in the 29th percentile nor the 32nd percentile. They want to hear it's more about themselves and make it more efficient. So one of the ways that we found, and I'm sure many of you are doing this, if you have to deliver a message and a message of how things work to clients, and you're not too sure if you feel that the audience may not, understand some of the terminology, here's a chart we had built, part of our program. And this is just basically putting it out there and really talking about the partnership in the program and how the plan, the advisor, and the whole program is going to help retirement success for that individual participant. So this is a partnership built on retirement planning. The common goal is to make your retirement planning easy, cost-efficient, and satisfying so you have enough to live a comfortable lifestyle in retirement. We just labeled it out. Your retirement success, your plan provider, your employer, your government. And then we talk through the different components of how you, the participant, will have success out there. It's really relatable. It's easy to understand. It's common language overall. So I thought when we're looking at this to be cognizant positioning certain educational openings or meetings with your plan participants. Make it simple, make it real, and make it engaging to that audience. So I want to take you through a couple of different other what we call study cards. We went out, and out of our 1,000 group audience, we surveyed basic questions on jargon, what we use, and what people feel and how they resonate towards these questions. So the first question we asked was around target date funds. And which do you most want your investments to become? Do you want them to become less aggressive over time, or do you want them to become more conservative over time? And here's the polling results around this. Less aggressive over time out of the audience, 40% said, yeah, I want to have my stuff less aggressive over time. But the overwhelming response is they want to have more conservative over time. And the resonating word here is more. The participants in our study, more means more money for myself. They like that word. Just like the word in the past, in the prior example, I talked about smart, tax smart. People like to hear smart. They resonate towards that word. So try to keep that in your contents as you're delivering this. Here's another example on a target date fund. A portfolio built to adapt to your lifestyles grows less aggressive over time. So here's a typical target date fund example. Most providers out there, when they look at target dates, they talk about how it's more aggressive now in their younger years, and say age 20, 30, 40. And as they get older in life, the aggressiveness goes down. And there's something that's called the glide path. You glide as you're going down. With our study, we found that glide path, number one, and this chart where it's going down is a negative connotation to the investors, to participants. They actually want to have something that's going to show them, not something that's trailing down. Because when you think about it, downward trend, what does that mean? It's a downward trend. I'm losing money. Even though you're not losing money in this range, the audience did not feel secure about glide path. Number one, they didn't really understand it, and the fact that it's trending downward. So we repositioned this target date model and said, well, how about this? How about we build you a portfolio to adapt to your lifestyles and grow more conservative over time? And in essence, we start off with less conservative now, and then the glide path, or we changed the name to call it the investment path. And that's something to consider. Even though it's glide path and all the language and the target date materials that are out there, the investment path over time is going to get more conservative as you get older. And what does this mean, and how does this resonate for the audience? It's more money, and it's trending upwards. They feel more comfortable investing in this type of investment vehicle. Something to consider, and something to consider with the different fact sheets that are out there and how they position this stuff for you. Here's another analysis out there. This is a trend analysis, a question we launched out there. Which of the following funds would you rather invest in? An investment that maximizes gains or minimizes losses? So back in 2007, now we've been doing this study. We do this study every couple of years. We've been doing this whole program for the last 20 years. This particular study, I forgot to mention, was conducted in the 3 major cities. It was conducted in Los Angeles, California, Atlanta, Georgia, and right here in New York City area. So it was conducted over those trends. So we're getting sampling of everybody who was here in the local area. So right off the bat, they want to minimize my losses. 37% said yes. Maximize my gains. Overwhelming. They want to maximize my gains. And if we see that for now, even through 2018, it's maximize my gains. I'm sure the first quarter of this year, everybody would say the opposite. But as we look now, and we're going to conduct a survey again, it's maximize my gains as a trend. And that's something you may want to use as you're positioning to your participants and to your clients. There's another trend. Which of the following is most important to you? That my investments are low cost, high value, or cost efficient? Now, in our industry, we talk about low cost, low cost, low cost, low cost. But what does really low cost mean? When I think about low cost, only 11% of the population said low cost sounds and makes them feel good. Whereas high value, okay, that sounds better. And then cost efficient was really the right thing, cost efficient. Because when I think about low cost, yeah, I got a low cost car. It's a cheap car. It's going to get me around the corner, but maybe it's going to break down. That's how participants are viewing that word. So think about that going forward. The same thing holds true with individual investors that are outside qualified plans for your retail side of the business. It was mostly cost efficient and high value, almost neck and neck with that idea. Another example, which of the following do you least like to pay as an investor? So this is around fees. Do you like to pay commissions, fees, charges, or costs? This is the least like to pay. So right off the bat, it says, I least like to pay costs as an investor, charges, fees, or commissions or fees. Fees is a negative connotation. People do not like to pay fees. So I know we're all fee-based advisors. When you're communicating to your clients, you want to mention, honestly, costs. People more resonate towards the word cost because, yes, there is a cost to something. There's a cost of using R.E. Rosenbaum as a ERISA attorney. People look at fees and say there's a fee. Well, what are fees based on? There's a late fee, doesn't make you feel good. There's a fee on my cable bill that keeps going up, doesn't make you feel good. Cost is more something that resonates better with plan participants and plan sponsors. Another way to think about how you communicate your language to clients. Another example, which of the following would you rather hear from your employer? Due to the large size of our plan, number one, we're able to offer access to institutional investments that would be difficult to obtain as an individual investor. Okay, does the audience understand that? Or we're able to negotiate lower fees so more of your money goes towards generating returns. Overwhelming response is a simple, plain language. A lot of folks don't understand what institutional investments are. We do, our world does. The general public, no. They understand negotiating lower fees. So consider that as part of that. And one more in this section is, which is the best reason to take advantage of your employer's retirement plan? Here are the four options. If I miss out on the match, that's like saying no to a raise, or the match is free money, or the match allows me to invest more in my 401k plan, or if I don't, I'm leaving money on the table. So which is the best reason to take advantage of your 401k plan? People resonate more with the word free. So when you're communicating match, talk about free money. It's free money that resonated the word free overall. So, and if we're looking at this section on the positive results, when you're talking to your participants, you want to talk about, in essence, things are more cost efficient. Overwhelming response, they like that versus low cost. So I want to take you through a couple more examples while I have you here. Here are marketing folks. They put this kid with a rocket ship out here and he's going to blast out here. I wish I could do this as a child out there. I was trying to do stuff with my skateboards when I was young living in Brooklyn, but I never thought of this concept. And what this is about is out with unrealistic claims, in with plausible, credible benefits. So I'm going to take you through some additional language that we use that is found in these different types of educational meetings. So here's a question that we tested for an advisor was asking, when it comes to retirement, my top priority is to have a comfortable retirement, maintain my current lifestyle, or dream retirement. And which do participants resonate towards? Overwhelming responses, they resonate towards a comfortable retirement. And that was from 2007, 2009, and 2018. We did this through different time periods, especially even when the 2008 bubble happens, still it resonates. They want to have a comfortable retirement because that is real. They can achieve that with what they're investing in going forward. Another example, when it comes to retirement, I hope to achieve financial freedom or financial security. Which do you think participants would resonate towards, financial freedom or financial security? Overwhelming response is financial security. Financial freedom sounds great, but security, like a security blanket, it's going to be there for there. And that same word resonated throughout 2007, 2009 after the crisis, and most recently in 2018. Financial security is the word to use as you're communicating to your clients. Also around this, to think about this for the millennials, we have a lot of millennials are coming up that are going to be part of the educational meetings. Financial security, even though it's almost close to financial freedom, they still resonate towards financial security. And we think it's even going to be more so when those millennials go out and buy a mortgage. They buy a house and they have a mortgage. Yeah, they're going to want financial security in understanding how they manage their retirement plan. So use that word when you're speaking with them. Another question we asked, which investments are best? Investments managed by institutions, Wall Street, MBAs and CFAs, experts, or professionals? Now, it's funny, in our world, we look at, institutions. We're like, yeah, institutions. Well, let's take a look at the results. Wall Street got 2.3% of the audience said we want to have their managed by Wall Street. There's a negative connotation on Wall Street, maybe for all the press that's out there. MBAs and CFAs, honestly, they didn't care. Institutions, maybe some people got it, but most people didn't understand it. They want to have overwhelming responses, both experts and professionals. So when you're positioning yourself against the clients, you are an expert and you are a professional in managing their money. So in this case out here, under plausible, you want to talk about having a comfortable retirement is overwhelming response versus a dream retirement overall. And in the last section, this is called universal communication. This is really, in essence, when you're communicating to your clients, communicate in plain spoken English. Cut out the jargon. I know when I sit down with you and we consult together, you and I may talk jargon. We bring that jargon into that plan sponsor meeting. And I've seen this before. I've seen record keepers bring it in, if you bring it in, and they use a jargon and they use an acronym, and the client has no clue, you may have lost that business. Same thing is when you're doing that educational meeting, you may have lost that business with that participant. So here's a couple of examples out there. Which is the best way to describe a defined contribution plan? Should it be defined as a savings plan, a retirement plan, or an investment plan? Again, most folks don't even know what a defined contribution plan, even though that's a 401k plan, or a 401k plan is a type of defined contribution. Most folks don't know. So based on our study, out of 1,000 folks, savings plan got 11%. The investment plan got 17%, yay. Overwhelming response is retirement plan. Position it as a retirement plan. Do not use the language that we speak in. Make it simple, or use that acronym KISS. Keep it simple, silly. Target date funds. Which of the following names is the best for this kind of investment? A target date fund, a risk-adjusted retirement growth fund, a target retirement fund, a goal-based retirement fund, or a life cycle fund. This one was a little bit interesting because, it still has your messaging. You're still getting the education around target date funds. Life cycle funds, 11% of the audience kind of got it. Goal-based retirement funds, 15% of the audience. Target date funds, still low, 17%. Target retirement fund, 22%. But the overwhelming response resonated well with risk-adjusted retirement growth fund. So that may be a concept you may want to use in your language when you're speaking to clients overall. So again, target date fund versus risk-adjusted retirement growth fund. Maybe in essence look at that. So the last section of this, in the last 5 minutes of my presentation, I just want to share with you to choose your words carefully. And here's an example. This is choose your international words carefully. This was interesting because you never know who's going to be in your audience when you're speaking with investors. Now here within U.S. investors, we talk about where do you allocate your money? Investors allocate their monies in baskets. We understand that word. We put it in baskets. If we're institutions, for us, we talk about buckets. And I use that term all the time. We talk about putting in buckets. If you're in the United States, in the rural part of the United States, they talk about envelopes. They like to put their money in envelopes. So something that's a little unique. If you have a Japanese investor that you're speaking to, they put their money in wallets. They like the word wallets. And if it's a United Kingdom, a British participant, they like the word pots. They put their money in pots. And actually, they actually call their United Kingdom 401k plans, they call them pension pots or pension schemes. That's an interesting fun fact out there. So universal communication is critical and it needs to be personable. So here's an actual study that we did. This was from a financial advisor that was talking to his client about around the markets. I want to read to you what he said, and if you could listen to the context of how he positioned it. Here it goes. If you come to me with a concern about something happening in the market or around the world, my job is to put it in the context of you. I believe we should take a step back and talk about where you are in your financial plan, because it's not about my opinion, it's about your individual goals and how this risk could affect them. So the first thing I will do is work with you to determine your exposure to this risk, how it could or could not affect you personally. I will give you a realistic assessment and have those tough conversations with you so you won't be caught off guard. And lastly, I think it's important to analyze and bring to life the potential benefit of any choice we make. So how did that resonate? As we could see here, that resonated very favorable to the audience members. Why did it resonate favorable? This is the actual verbiage, and here's why. He only said, the advisor only talked about himself, I, 4 times, only 4 times. But when he was talking to the client, he spoke to them directly 10 times. He used the word you or your. In this case, if you're talking to a client directly, use their name. But he used you or your 10 times. It made them feel special. It's about them. It's always about them. It's never about you. So be cognizant if you are talking to clients to change your habits if you're doing any of this. And then lastly, which is the most helpful towards track, which is most helpful to track your progress toward saving for retirement? You're on track compared to the national average, peers in your company, or the retirement goal you've set. Which you think? I think overwhelming response, you'll get it. Peers in your company, national average, nope. The retirement goal you've set is what they want to hear. They want to know, again, it's about them overall. So again, on this, it's always comparing to the retirement goals you set, make it about them. So as we discussed today in today's presentation, redefined contribution, engaging participants with clarity. You know, we talked about being positive, we talked about being plausible, being plain spoken, and being personable. And that's really it. On that note, we do have an exercise card. If you are interested in reviewing some of our information out here, you can go to our website. It's called invescoconsulting.com. You can see this material out there. You can take a look at it. We actually have an exercise card. If you are interested, you can reach out to me. Ari will get out the information. I'll send everybody a thank you email. Again, thank you for the time. I wish everybody a healthy and safe holiday season, Thanksgiving, and holiday season after that.
Tom, you just have one question.
Okay.
You want to look at the Q&A? You want me to read
Yeah, I
it?
got it. Tom, I know from the presentation that proper word usage in participant presentations is critical, but is conscious even more important. Maybe it's just me, but I tend to tune out most every presentation after 20 minutes or so. Present company excluded, of course, regardless of level of interest. Okay, you're absolutely right. You're absolutely right. So it's about, you know, proper usage. You know, keep it simple, keep it short. You know, when you're talking to participants, you want to keep it short, concise, and to the point, because they will fall asleep if we don't do that.
Okay. Tom, thank you so much. I appreciate it.
You're welcome. Thank you.
Hope to
Folks,
see
thanks,
you,
folks.
hope to see you at a Yankee Stadium event eventually.
Absolutely.
Our next presenter is Jerry Yen from Advice Analytics. Jerry, how's the weather out there in San Diego?
Oh, it's fantastic. But well, actually, I shouldn't rub it in. So it's another boring day in San Diego, about 70s. So but hey, listen, we just got back from New York last October, and that was right before they closed the borders across all the states for all the travel restrictions. Yeah. So we're very happy to get out to New York. But yeah, and we'll see how the Yankees do next year.
We'll see. Well,
let's beat those Dodgers.
I'm a Met, I got more personal problems. Okay, Jerry, you can share your screen.
All right, so let me go ahead and share my screen here. All right, how is that? Can you see that?
Yeah, you started screen sharing.
All right.
I see it.
All right, outstanding. Hey, so I actually wanted to present a couple different ideas here. And the idea, and thank you very much, Ari, for having me here. So we're going to focus on probably what is going to be an extremely exciting topic Friday afternoon after lunch. Here you go, audit-ready document storage, but it gets even better. So we'll get into this a little bit. So some of the words that might strike some fear in your hearts is really around IRS audit or DOL investigation, and that's actually two different things. And I don't know which one is better to be audited or investigated. But in any case, each department, of course, has their own name around this. And I don't know how many people went to the virtual Napa Summit, but they had some great conversations around auditing there. And some of the best practices that they talked about here was around fast response to document requests. So as plan managers and administrators or advisors for our clients, really focusing on fast response to document requests is the first sign that either the IRS or the Department of Labor look for to show that you've got your finger on the pulse of what's happening with the plan. Secondly, notifications for document updates. What we found was that the more you can be part of that process, the better you can help your client. Third, around automatic workflow. Is there a way that you can actually know that when you change the fund in the investment lineup, that you can actually know the next 3 steps after that? And then training after staff turnover, which oftentimes is, unfortunately with the pandemic, is occurring a little bit more often. And Melissa Kurtzman had a great number here, which is most penalties for larger firms start at $1 million, less for smaller firms, but still in this day and age, certainly with what's happening now, not something you want to face. Unfortunately, when we were looking deeper into the types of products out there available, you end up with very ancient file hierarchy storage, or even Google Drive, which just has folders and no real logic behind that. So we, my team and I decided, we can do better. Now, an IRS audit or Department of Labor investigation strikes fear in most people's hearts like this. And I don't know if anyone remembers from the August presentation, I showed this here as striking fear there. And it's very similar to when you get a knock on the door from the IRS or ERISA. So we wanted to set everyone up for success with peace of mind. So we created a smart fiduciary file repository for defined contribution plans. And you can see here, just to jump right into our product here, and I'll show you what the actual product looks like as well. But here at an upper dashboard, you can see multiple, you'll see even multiple, I'm definitely not Jerry Schlichter, but we'll see multiple plans across your portfolio and your client list. And here you can see a couple of different things. Auto alerts and actions needed around that with regards to which ones require most attention, and the ability to prioritize across your plans on how to help them. Uh, and then diving deep into the actual plan level now, being able to see at a plan level all the documents needed for that particular plan. And automatic updates that will go into a smart workflow as different investment lineups or your investment funds are changed in the lineup. You can now know, for example, the 408B2 disclosures and the 404A5 disclosures that need to be sent out. We have integrations that are being built out right now with Salesforce, for instance, as well as an activity log of stream of activities that you have to do, that you should do in the future and you've done in the past. Something you can show plan sponsor clients about the value add that you've offered to them in protecting their plan. And now is the season, right, where audits are starting to come out. The Form 5500s have been delivered, and now audits, the IRS and the Department of Labor are all very active now, targeting different plans for review. So being able to respond quickly with an audit ready button here at the bottom to download the right documents in response to their requests is going to be critical. And at this point, so we've offered and shown this to multiple plan sponsors and record keepers as well. And this is actually our first time we're talking to any advisors or plan advisors or TPAs. And this is some of the response we've gotten from, especially from plan sponsors. And the idea is to make this extremely easy for everyone to use. And the response has been amazing. We've gotten folks who've talked about immediately they want a proposal. They've talked about how RoboVault, what we call RoboVault, think about it as RoboAdvisor, except we're really focused on documents. So RoboVault would automate much of the tedious work that's involved in compliance and documentation, where our smart workflow, we're designing with industry help and feedback, and we'd actually like your feedback. And what's really interesting about this is that there's an interest in paying some fairly decent fees for this type of service, which of course I'll get into a little bit later, but as a program for advisors and TPAs could be a reseller program where there certainly is some incentives with regards to that. And then a number of different plan committees of mid-sized firms are of very high interest in making sure that that kind of oversight is actually being done. So let me actually switch over to just a quick little demo of the product itself. And you can see here a couple things, right? You can see what I talked about plan level, and you can see as an advisor or TPA your book of business basically. And based on that, you can always track on a regular basis your total AUM, your total participants. We've even included some industry feeds that is able to offer that kind of updates for the plan, for your plan sponsor clients. And now let's go ahead and say, okay, we're most interested in Acme Inc. It's got a big red X, very simple to see where things are broken. Let's go ahead and click on that. Now you dive into Acme Inc. for plan year 2020. And by the way, you can get to other plan years as well. And you can now see specifically based on the red X's, which documents need to be updated, either by timing in the calendar, as we all know, for Form 5500s, or based on a trigger action, which would be, for instance, a change in the investment lineup. Changing the investment lineup, for instance, or your benchmarking reports that lead up to the investment lineup would be X'd automatically so that you can now highlight that and pursue that. But let's go ahead here and let's just say, for instance, your Q2 meeting minutes. Jenny Anderson, who is your client plan sponsor, your contact at your plan sponsor, needs to hurry up and get the Q2 meeting minutes. Here we are at Q4. So as a gentle reminder, you can go ahead and click on the email icon right here, and the system will generate an automatic email sent that you've gone ahead and predefined and pre-approved, and say, hey, you're missing blank, missing the Q2 meeting minutes here. Hi, hello, Jenny. It's an email initiated by the RoboVault system. One of the feedbacks we got was that it's sometimes hard to have these difficult conversations with your client as a reminder when it comes from you personally, when you're pestering them. The beauty here is that it's an automatic email, and if they still haven't answered, you can actually, quote, pester them without it being you. So John Smith here is not the one sending the email, it's the RoboVault system. So now it's the system. If there's any complaint, you can say, oh, I'm sorry, we can get back to that. Oh, but by the way, do you have those Q2 meeting minutes? Because audit season's starting to come up and we want to make sure we're prepared. So that's easy to do. But let's say they go ahead and they say, well, yeah, I got the RoboVault email and I just emailed it to you. Perfectly, no problem. I look through my emails, and John Smith looks through his emails and he goes, okay, no problem. Here are the files. Let's go ahead and upload for these remaining 3Xs, which we can go ahead and upload. We can say, yep, let's go ahead and upload those 3 files, the schedules, which we just, we sent in, but we didn't record it. And then go ahead and update any uploads to confirm that they're done. And then boom, you are now left with green check marks that you can now display and showcase for your plan sponsor. There's a question here about, shouldn't the plan sponsor? Absolutely, they should have the documents, but that's why an advisory firm can add value. We've talked to a number of plan sponsors, and there's oftentimes that kind of, hey, you know, whose job is it? Of course it's their job, but it isn't a nice message to say, I can offer you a service for a fee where you can outsource. Well, you can't outsource the liability, but you can certainly task your advisor as a value-added service to go ahead and take care of this. And the idea here is you now can get to a green checkmark, red-free zone where everything is now taken care of. And we've actually had different plan sponsors say to us, we would love our advisor to take a snapshot of this and just send us this. How beautiful would that be? So that's the idea behind this. And we've received such great response. It's been pretty amazing. Again, as you can imagine, some fantastic response for this. And again, this is in response to an IRS audit or a Department of Labor investigation, depending on which side of the coin they're looking at. And it often is sparked, whether you like it or not, by the Form 5500 and all the payroll data that is submitted by the company, the plan sponsor, who then cross-checks the numbers. The IRS has gotten very sophisticated, actually, which of course it makes revenues for them, to be able to check for any red flags around this. So they are, by the way, the IRS is doubling their workforce. Yeah, there's no lack of employment there because it is, and this is an area, EBSA, the Employee Benefits Securities Administration, is actually one of the key places where they are hiring to be able to increase the number of audits. And audits and penalties have quadrupled 4x in the past 5 years. So it's a reality of our business. A little bit about advice analytics here. And I wanted to be able to offer and get some feedback and questions on this. So I wanted to save time for that. But advice analytics here, we are a fintech startup with some strong funding, as well as experts, both in the founding team, as well as advisors around defined contribution analytics. I of course, have the CPFA with NAPA, but I've also spent time within Guided Choice, which is a robo-advisor, a digital advisor specifically targeted for 401k. So I have experience with the data, as well as our team has a broader experience within analytics, security, and the software as a system, as a service process. And we've built predictive analytics engines. And the whole idea here is to be able to tailor the workflow to the advisor and to the plan so that we start catching common mistakes, not in general, but specific to the plan and to the employer. And even to a certain extent, areas that the plan advisor would like to have greater customization for. This is our 4th startup. We've built 10 different products, successful products before, so highly successful. This is an area we find great demand and not a whole lot of solutions out there. So feedback, and I think I've talked a little bit here. You've got an idea of what the product is. I wanted to get feedback on 2 areas, one around the product and 2 around the distribution of the product. I'm going to start with distribution. So for small plans, and I'm presuming in the audience here, everyone's really focused around small plans, what I've defined as less than 250 employees. We're currently in discussions with different record keepers about larger plans in particular. So that's great. But for smaller plans, for an audit-ready plan file repository, right, a fiduciary file, with a smart workflow that offers alerts and tasks on what to do next, we wanted to offer and explore two different options. And I'd love to hear some feedback, maybe a bit of a vote. One is where we price it for the masses, $1,800. You can argue whether it's affordable by a very, very small mom and pop shop, but for the most part, $1,800 is an affordable service for them, with a provider incentive of $450, right? 25% incentive for the provider. And this is an annual basis, where if you had 100 plans, for example, you would make $45,000. The provider would make $45,000 on a regular annual basis. On the second side, you would have, for instance, a plan sponsor fee of $3,000, higher fee, but also a higher incentive, 30%, where the provider incentive is offered at $900. So again, $90,000 for 100 plans. I'd love to get some feedback, and I don't know if I went through this too fast, but I'd love to get some feedback on what your thoughts are on this with regards to option number one and option number two. One preferable over the other, or thoughts? Option one. So option one for Mike. Not close for you. What does that mean, Mike? I don't know. I'm talking to a chat. Sorry. But I don't know if Mike, if you wanted to. Oh, meaning option two is not so hot. Got it. And option two not so hot because the incentive, or because the fee is too high? It's too hard to sell 3,000 into a smaller plan. Fee is too high. Got it. Got it. Okay, good. Great feedback. And Greg has no opinion. Okay. No problem. Not a problem. Okay, good. I just wanted to get some feedback on, again, we've been talking to primarily larger providers. And as you can imagine, the challenge for us is the larger providers obviously have larger plans, and the fees there, we're talking literally $10,000, $15,000 is not a problem. But I wanted to get a sense of what when we look at smaller plans, for sure, and Mike says this, they need this badly, especially in partnership with the advisor, and I totally agree. What if you can type into the chat, what do we think the right pricing would be? What do you think would be the highest price they could possibly afford, that in your mind would capture a larger part of your book of business? Let's see what people type in this. So to answer, you thought 2K was about the ceiling. Okay, all right. And we got a little bit of feedback on that as well. So 2K is about the ceiling. Greg, you asked about getting notifications from this page. Absolutely. So ideally, you wouldn't want to be told that your Form 5500 is due tomorrow. You would actually want to be told that 3 months before, gather your documents, here's what you want to do. 2 months before, here's who you want to call. So all of that is automated because it's a standard process. And imagine all of that being standardized for the process. And here's what the key is, right? You can actually, as you bring on staff turnover, you bring on and hire new people, they can just follow the facts of the alert system that says, here's your workflow, here's what you need to do next to prepare for your Form 5500. Mike, we right now, we're just focused on retirement, but our number one request when we show this to plan sponsors has been, can you do ACA compliance? Can you do all these other aspects of it? And the whole idea here is to get into a good, strong, timed workflow so that you get peace of mind. And it's fairly straightforward to put that in to ACA compliance and other aspects as well. Do we have direct competitors? You know, everyone has a competitor, right? Human brains are one competitor in the context that people simply remember what to do next. But that's if you have a lot of experience, and oftentimes those folks, and we all know those, right? Those folks who know exactly what to do and how to do it, what needs to be done, and it can advise accordingly. A, they're hard to find, and B, they tend to be a little bit more expensive. So imagine now that we're down to $1,800 or $2,000 as ceiling, and all of this now is automated. So it becomes less of a flight risk if that person were to leave your employment. So that's how we view that. Other competitors, you know, there's other solutions as far as just storage, but we haven't found one that actually walks you through the alert and then what to actually do next. So that kind of alert and action, actionable sort of task flow or smart workflow, we have not found anywhere. And will PEPs affect the business? No, actually, that's the beauty of it, right? We talk about PEPs and there's fiduciary liability, but what do you think the IRS is going to do? They've got all the financials of every single employer in that PEP. So they're actually quite excited about the whole PEP opportunity to be able to start attacking in mass one particular PEP, I should say investigate or audit one particular PEP with multiple employers and make sure that the operational compliance across multiple employers is all consistent and documented accordingly. Having one particular centralized system to be able to force that organizational process makes that so much easier and so much better in terms of response to the IRS, who can knock on a PEP's door, think about it, and say, yeah, show me the employer process across all of your disparate employers. Now you're no longer talking to one plan sponsor. You could be talking to 100 plan sponsors, all of whom have different response times, different levels of organizational capabilities, and so on. So, let's see, I think I've answered all those questions. Snazzy, yeah. Yes, there are, we also have tried to make the user experience as gorgeous as possible, for lack of a better word. You know, we've tried to make this so brain dead easy to use that anyone could sit here and go, okay, I've got one goal in mind, get rid of the red X's. And how do I do that? I can look at right on the right-hand side where all the red X's are categorized and click on the email or upload it right there on the spot. I know exactly what form I'm looking for. I know exactly who I'm trying to get that form from. And I don't have to pester them. I can have RoboVault send the email, or I can manually trigger RoboVault to send the email in their name and pester them accordingly. Okay. So thank you very much for the response on the pricing. Great information. Let's see if there's any other questions. H&W. So right now we're just focused on defined contribution. In fact, we're just focused on 401k, but certainly extensible, right? And as far as ERISA compliance deadlines, absolutely, right? Compliance deadlines, documentation requirements, all of this is being built into this whole process. We're working with several ERISA lawyers. 403B, not exactly now, but that's coming up next. SPDs, SMMs, yeah, absolutely. So you can see here, for example, we call out some of the SPDs here, and so on, right? All documents that can be inputted in here. And the beauty is, you don't have to have this extensive, difficult, that's a good point, Greg. They are for H&W as well. Anyhow, sorry. So the whole point is extensible logic to 403B as well, to a much broader set. Right now, we're focused on 401k in terms of all the smart workflow. But you can imagine it's very extensible immediately once. So we've got the engine built. Now it's just a matter of setting the rules and the timing, and everything can be sent out accordingly. So how am I doing for time, Ari? Is that
You got like 5 minutes if you want.
okay? Perfect. So let me offer this and invite everyone. And as we continue to build this platform, and I would love to get your feedback in terms of what else we can add. Things like what Greg you're talking about here. some of the things we do, but some of the things I'd love to pick your brain a little bit further around where else can we make this truly a high value add for you and for your clients, for your plan sponsor clients. And as we start to get broader and deeper into this, really, how do we start, and this is what we've already heard from different folks, different providers, integrations with FI360, which of course has to be documented, integrations with ASC, integrations with everyone else, where we can actually now very, very easily be able to have this instantly updated. So imagine, since we're in a digital world, right, as the minute the form 5500 is signed, it's automatically loaded into here. If it's revised, automatically in here as well. And all of that activity stream is documented. So no need to search for emails and why did we do this? The bigger challenge is when the IRS says, now, why did you do that? Or what happened there? And you have no history of the why or the how or the when now you have a full activity log of what happened when, at what time. And oftentimes these audits, for example, could very well occur in late 2020 or early 2021 about plan year 2019. Who the heck remembers 2 years ago? And so this documentation is one easy centralized place for that response. And so that's the whole idea here. Make our lives easier. Certainly the pandemic has made everyone's life, including our plan sponsor clients and the providers, a difficult time. Let's make everyone's lives easier. Let's get through this second wave, whatever it may be, and really set up our clients for success. We invite you into this survey. If you can see the link on that's listed here, feel free to go ahead and type that into your browser and give us your feedback. It's a short 2-minute, like 90-second survey where we ask you a number of questions about what you saw, and really ask about your thoughts around how we can improve this and make your lives easier, make you some money within this program, and of course, at the end of the day, truly offer value for your plan sponsor clients, which at the end of the day is the real point, right? Let them focus on rebuilding their business and getting to growth again for their business and helping their employees, and a lot less about compliance audits, which they're this year, think about this, they're going to turn to you or someone for advice because they've got way too many things going on their plate. And so really helping them with this, and then even showing them, I mean, imagine showing them this with all the green marks. Actually, let me just show you that, right? Get this screenshot, and you're just that much more of a value add provider, and your client retention, your constant value add becomes very apparent, very visible for your plan sponsor client. So I invite you again. Sorry, let me show you the link here. I invite you again to go onto the link and give us your feedback. This is your product that we're trying to build for you to better support your plan sponsor, and of course make some revenues off of that as well. Okay. Well, Ari, I don't know if you have any comments on it either, but I think I've answered all the questions, and I think we're just about at the end of our time.
Thank you, Jerry. Great presentation as always.
Absolutely, of course. Thank you.
I'm going to just do a presentation, just take a couple of minutes. I have to shill for my event that's coming up. It is what it is. So anyway, how do I say this? Back in March, we had that 401k national conference that was at Walt Disney World. Unfortunately, there was this little thing called coronavirus, COVID, that pretty much shut down the rest of the events that I had scheduled, which was going to be April was going to be in Houston. May was going to be in St. Louis. June was going to be Minneapolis, and December was going to be Las Vegas. And of course, when it came time to it this past summer, I said, you know what, we were not going to, you know, based on the situation that was going on, to try to plan another national event with this raging on made no sense. And anyway, the place where I wanted to hold it, Disneyland, as far as I know, is still not open. So I decided that way back when in the summer, let's move the event earlier in the calendar and let's do it all virtual and just not deal with the headaches of trying to book an event and trying to get people to go and, you know, dependent on a vaccine. And, you know, of course, I talked to somebody I know very well in the industry, and she told me her travel is not being, you know, allowed until April. So that kind of made the idea of a virtual event the better way to go. So the particulars, unlike these events, which are now 2 hours in length, we're going to go 2 days in a row, January 21, 22, 2021. After I booked the event, I finally realized that we were going to get an inauguration on the 20th. You know, you kind of figure you're just going to think about all your stuff, but yeah, we have inauguration on the 20th. So right after then and there, we got an all virtual Zoom event. All the features of a live conference, just no food. So I'm sorry, we can't, you know, finagle giving, you know, sending out orders all around. And of course, like I said, Thanksgiving, $20.21 is the early bird special. There are other levels. If you want autographs from Walt Frazier and Doc Gooden, you can pay for that. You want a t-shirt, you can pay for that as well. The early bird rate ends at Thanksgiving, and I believe the new rate is going to be in honor of the movie Naked Gun 33 1/3. It will be $33.33. You know, there'll be obviously great presentations on PEPs because, of course, that's the flavor of the month, and PEPs are just going to come into play on January 1. That's the effective date. Plan audits. Sherry Fitz will be there talking about marketing for plan providers. And, you know, obviously, the whole idea behind an event is that there'll be, you know, conference, basically sessions on how to grow your business, as well as changes in the law and how that it may affect you as well. Sports guests, like I said, day one, Walt Frazier. If you checked on LinkedIn and Twitter, he cut a video for me last week, which of course he pronounced himself as the greatest Nick. And I actually agree with him. I think there'll be some Patrick Ewing fans that will disagree. But Walt in the video showed his 2 rings, which is 2 more rings than Patrick Ewing got. Day 2, the guest is going to be my good friend. I don't know if he thinks that, but my good friend, Doc Gooden, Dwight Gooden. He was, I brought him back, always big fan of Dwight. I would see him a couple times a year at autograph signings, but, you know, he's special to me. He was the very first guest of that 401k conference all the way back in June 2018. Political guests called in a favor. Congressman Jamie Raskin, Democrat from Maryland. He was the associate dean of the law school that I went to. And when it came time to complaints, he served as my complaint department. If you would have told me 25 years ago that Jamie Raskin would be in Congress, I would laugh. I would laugh at you. But it'll be great to have him on. He's got 15, 20 minutes of his time. Obviously, we booked a time that isn't very nice to our Pacific Coast friends. It would start somewhere around 6 o'clock their time, 6:30 their time. But that's the time frame that we have for him right now. Hopefully, as they get closer, they will book a more friendly time period for our friends on the left coast. So it'll be great to talk to Congressman Raskin about what's going to go on in Congress in 2021. Of course, like I said, we have what will likely be a President Biden on January 20th. Also on day 1, for those who were in Orlando at Disney World for the original 401k National Conference, we had Ron Nearing over there. He's an MSNBC conservative commentator, also does commentary for Al Jazeera. He was the national spokesperson for Ted Cruz in 2016 and Ted Cruz in his re-election campaign in 2018. And he's always great for a kind of bipartisan chat about what will go on for 2021, how that'll affect, you know, the retirement plan business and just some interesting takes on that as well. Of course, day 2, the Retireeholics will be back again. It'll be funny how they do it virtually. We're going to do it on that Friday because Thursday night they always have their little Zoom event, so I didn't want to walk all over that. It should be fun and how we're going to figure a way how to incorporate them into my Zoom account, but we will find a way. And for those who haven't seen, I did appear on an episode that was filmed. Can we use the word filmed anymore? We can't use the word tape because we don't use tape anymore, but we recorded at the event at the Walt Disney World Swan. It was a lot of fun. Hindsight's 2020. I don't know if I would have drinking Corona again. And I guess it's considered maybe a bad taste now, but at the time we really didn't know the consequences of coronavirus. And for those, the event ended on Wednesday. By Sunday, the park was closed for the following 3 or 4 months. Some of our sponsors with presentations. John Russin was my guest a couple weeks ago on that 401k virtual bunch. Pension Assurance will be there. I always give a good presentation on audits. Matrix will be there in conjunction with FI 360. So if you have accreditation with FI 360, there will be an hour or 15-minute event that you will get continuing education credit. Russell Investments will be there. PCS will be there. We may discuss something that's in the pipeline with me and PCS. Granite Group Advisors, CUNA Mutual, Valley Point Associates, Nationwide, Mass Mutual, Schwab. There's so much more. And, you know, as we get closer and closer to the event, we're going to get more and more sponsors. You know, it's not like one of these grand national conferences that take 7 to 8 months in the planning and 7 to 8 months of trying to get sponsors to partake in it. And again, the cost, $20.21 and up. It will be $33 1/3 after Thanksgiving. To sponsor, $750 bronze. That's to just show up, say hello, get your logo in with the sign up stuff. $1,500 is silver. You got a 30-minute presentation. The $2,500 gold, that's to be in for 50 minutes. And to sign up for more info, go to that 401ksite.com / that's 401k virtual conference, or just check the link above top. And of course, I always have to end with it's all ball bearings these days. Big fan of the movie Fletch. So again, that's my information, and that's it. I appreciate everybody attending this event. That's about it, as they say. So I thank everybody for attending this event. And of course, the next one that we do, the mini one, will be on December 18th. So thank you all so much. Take care. Bye.